Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, fundamentals analyzer software tool, and of course one of the co-founders of the Dividend King service on Seeking Alpha. I'm really kind of excited about presenting this video today because it's really on a subject that actually turns out to be a pet peeve of mine, and it's something that I originally, when I first got in this business almost 50 years ago, I originally bought into kind of hook, line, and sinker. And that concept was that there would be an inverse relationship between stock values and interest rates. When interest rates are low, stocks deserved a higher valuation. When interest rates were high, stocks deserved a lower valuation. On the simple thesis that when interest rates were high, fixed income competed more against stocks than when they were low. When interest rates were real low, then stocks became more competitive, and the laws of supply and demand come into play. Now, I do believe there's a lot of truth to that, frankly, but I do believe it has nothing to do with intrinsic value at the same time. It has everything to do with market value. In other words, in the short run, there can be sentiment that drives stock prices. I talk about this quite often. But in the long run, fundamentals rule. And there's been numerous studies recently done that really validate that. And of course, my own anecdotal experience over 5 decades of doing this tells me that, I trust fundamentals more than I do stock values or stock fluctuations, maybe is a better way of saying it. But anyway, right now we have one of these unprecedented period of low interest rates that have been sinking for many years. And we also have a bubble. I mentioned that in my previous video I did where I talked about the high valuation of the market, how it was actually a cap-weighted index, the S&P 500, how technology was dominating that, and how there was a lot of technology that was in a bubble. All right, and talked about that quite extensively, but a lot of people are trying to say that's okay because interest rates are currently so low that techs actually deserve, to have these higher valuations. And my argument is this: I don't care what anyone thinks about what the company might deserve. All I care about is what you, the investor, deserves. And I believe you deserve to invest in high quality companies at attractive valuations so that you can participate in the full measure of the company. Now, the other point is this: interest rates can have an effect on some companies depending on how much debt they carry. Like I always say, like I said, what do you talk about a company that has no debt? How does interest rates impact them? But the bottom line is this: when you look at a business, the internal factors that drive its value really all are determined by how much growth the company is able to generate. Things like the marketplace it's in, how much margin they can squeeze out of their product, how much competition they have, the total size of their market, how efficient they are as capital allocators. All these factors are the things that really matter because it is a market of stocks and not a stock market. So I'm going to just take a quick look. I'm going to use several examples here, most of them high profile, not all of them. And I'm going to show this idea that there is kind of the notion that stock prices and interest rates have this inverse relationship is not necessarily true. In fact, it can actually be quite misleading. What really matters is how much cash. All businesses, all investments get their value from the amount of cash they generate in their stockholders' behalf. So really it comes down to the growth of the business. And if low interest rates help a business grow faster or grow significantly faster, then that can make the stock more valuable because the interest rates would have, contributed to their growth. But if it has no impact on their growth, then interest rates become irrelevant because you're investing in the individual stock or individual business. You're not investing in the market, and you're not investing in, interest rates. They're exogenous, and they have really no bearing on what you're going to do in the investment. So let's start with Alphabet, one of the, larger $135 billion market companies. You can see that when you look at this valuation, you can see that the stock has grown at a rate of 36% a year. And that's extraordinarily high. You're not going to find very many companies that grow that fast. But I also want to point something else out to you. You got to be careful when you're looking at statistics. Statistics, don't lie, but statisticians are darn liars, as they like to say, because when you look at this number is mathematically correct. However, you've had 263% growth in 2004, followed by 260, followed by 76. And by the way, I noticed you had very high valuations during this time because, the growth was unbelievable. Then all of a sudden you start seeing growth, get into the teens, 15%, 17%, then down to 3%, 22%. 12%, 19%, so on and so forth. So what's happening is the growth rate is changing dramatically. But from a standpoint of really getting the full measure of the company's growth. Had you invested in this stock back on September of 2004 when it went public and held it to today, you would have averaged over 23% annualized on your money. Now, the stock was pretty highly valued back here. The PE was 106. And right now the PE, the blended PE is 33. So you've had PE contraction in this period of time, but yet you still, turned $10,000 into $310,000, almost $311,000, a 30-fold increase just based on the fact that the business grew very quickly. Now, of course, I want to show you something else about valuation. Had you bought this stock in the throes of the recession and held it, you would have still made an incredible amount of money, a very similar rate of return. And the question is why? So why did you make, only 23.9% here when you bought it so cheap? That's because the growth rate has changed dramatically. As I shorten the time frame, you can see what happens to the growth rate of the company over time. And I'm sorry, I went the wrong way here. If you shorten the time frame, you can see that the growth rate drops to 15%. And then if I shorten the time frame again, the growth rate drops, to just under 15%. Run it out, a little further, and it's still around 15%. And I look forward, the point is growth is expected to stay around that 15 to 17%. Near term, about 15.8. Trend line 3 to 5. 16.8. But all of a sudden now Google, or Alphabet, as it's now called, looks significantly overvalued. But look at the PE to interest rate graph on this company over its history here. I think this is a really, really telling story. Here's a case because of the slowing of growth now. That was the factor that mattered most in the case of Google. We went from having a PE ratio of 129, back in 2004 to the current, last year's ending PE ratio of 29 and the current PE ratio, blended PE ratio of about 33. In other words, here you have a situation where interest rates, fell dramatically. You can see the 10-year Treasury bond interest rate fell from the 5 and 6% range down to less than 1% by the end of January, of this year. And yet you saw the PE ratios shrinking along with that. So this idea that there's an inverse relationship between interest rates and stock values doesn't hold water, at least in the case of Alphabet. Now, another example I want to show here is Southern Company, which is an electric utility stock. Very low growth, 3.4%. Okay, if I look at the performance of this company over this time frame, the growth rate was 5.3% in terms of capital appreciation. You end up making 8% because of dividends, but you can attribute that to high valuation. The stock only grew at 3.4%, but it started out fairly valued and it ended up overvalued. But the point is, interest rates had very little to do with that. When I look at the PE to interest rate graph on Southern Company, the PE's all over the place, even though interest rates have been steadily dropping. It went from being real low to real high. And of course, that's a function primarily of how the company's growth rate and how the market reacted during things like the Great Recession. So interest rates can have an effect. I'm not saying they can certainly have an effect on the short run, but they don't really determine how well, what price you should pay for your stock, because that's going to be determined by the fundamentals of the business itself, how fast it grows. Again, all the things I mentioned at the beginning of this video. Then we can turn to something, a very fast growing stock like Facebook. And I'm going to cut 1 year off of this graph here so I get a little better valuation. I have a 36% grower here, which is obviously extraordinary. And if I look at that, I see the PE ratio is currently 25. That would it would be undervalued. Back here in the beginning, the PE ratio was 50. And if I look at PE versus interest rates, I see this steady decline in PE ratios during a time when interest rates themselves were in a decline. So in this case, they moved in lockstep tandem. Interest rates went down, stock valuation of the PE multiple of Facebook went down with it. And it all had to do with how the company's performing as a growth stock. And that's the point. It's a market of stocks, not a stock market. The individual stocks are what matters. Now let's look at it from the other perspective. Let's go in reverse. Rather than look at all this nice growth, let's look at a company like Canon, a technology, hardware, storage, and peripherals company, a la, you might say similar to an Apple, for example. But the point is, here you have a company whose operating results have steadily deteriorated. If I look at the PE to interest rate graph on this company, again, it's all over the place. There isn't any real direct correlation or inverse relationship between interest rates and stock values, or stock multiples. What really drives the valuation of this stock was the fundamentals of the business. And from a performance standpoint, we have a negative operating earnings growth rate over this period of time. And if I look at performance, I have a negative capital appreciation. I did get some nice dividends, would have allowed me to squeak out a very meager 3% annualized rate of return over this period of time. But, had I bought it at a peak valuation like here and held it to here, I'd have actually suffered, an annualized 3% negative rate of return, even including dividends. Interest rates are not that big a factor, is all I'm trying to get across with this particular video. I look at a company like AmerisourceBergen, I got 12% growth. I look at its historical performance. It comes very close to what the company generated as an operating business. The valuation has tracked the company's earnings at around a 15 PE ratio very closely. When it gets above it, it comes back, and this is all independent of interest rates. I look at PEs and interest rates. The blue line, of course, is PEs. Interest rates have steadily gone down, and yet this company has maintained a very consistent, PE multiple between, 15. There are times when it's been low, like it is currently at 12, but generally it moves into line with this 15 PE ratio, and that's the real point here. Now, I also point out in what I wrote here that, the cash flows that the company generates, you can measure that by earnings, you can measure that by revenues or sales, you can also measure it by operating cash flow. In Amazon's case, it's all about operating cash flow. Here we have a 30.59% operating cash flow growth rate. We also see the price track that almost perfectly. Now, my price to sales graph only looks at earnings on this stock. So when I look at PE to interest rates on Amazon, I'm looking at it relative to companies' earnings. And the reality of it is, because this company does so much reinvesting, their earnings have been all over the place. They're very spotty, and they don't really justify the valuation. It's hard to get a value, reference or perspective by looking at Amazon based on its earnings, especially over the long run. The company's profitability is starting to increase dramatically, but in reality, the stock price hasn't been very well connected to their earnings over time. But yet, when I go back to operating cash flow and shorten this time frame a little bit to kind of smooth things out, you'll see that operating cash flow and the company's stock price have moved in tandem, and the company's performance over this time frame, which is 35.9%, is very consistent with, more or less a little bit less here of what the growth rate, and that's because the stock looks a little undervalued based on its normal priced operating cash flow, which I don't have on the graph, which I'll go ahead and put on the graph, which has been about 24, so it would look actually fairly valued here. And then last but not least, I want to summarize all this with Microsoft, because Microsoft tells me a couple of stories here. Number one, if I look at this company from the standpoint of the long-term record, all of a sudden we do have some acceleration in growth. I did a video on this just recently, and I see this real disconnection from price and value. But when I look at this long-term graph, I also want to point out it wasn't too long ago, coming out of the Great Recession, that I had even single-digit multiples on Microsoft. But I also go back to 2000, the irrational exuberance / tech bubble era, and I had very high PEs, 47 on Microsoft. If I look at it from a PE to interest rate perspective, if I go over this long term here, if I scroll this back, what I want you to see is that we have a period of time here, a full decade. Well, actually, I went a little too far. I have more than a decade here where where interest rates were steadily dropping, as you can see here. And yet, so was Microsoft's PE ratio steadily dropping. Again, this, belies the idea that there's an inverse relationship with interest rates and stock prices. As interest rates dropped, the PE value of Microsoft dropped along with it. Now, I fast forward that, I go forward and look at the last decade, and then all of a sudden, we have a slightly different picture here. What we see here is we see interest rates continuing to drop, and now we have the relationship that conventional wisdom says is normal. The PE ratio steadily increased as the interest rates decreased. This is what it's supposed to look like, but the point is, in certain situations that can work beautifully, but it is not the dominant factor that most people think. You don't justify paying a higher valuation for a stock just because interest rates are low. You pay a higher valuation because that company's growing faster, it's generating more cash on your behalf as a shareholder. When that cash flow gets disconnected from valuation, if you overpay to buy even the greatest company in the world, you are not helping yourself, in my opinion. Buy low and sell high. Buy low and sell high is what the theory of sound investing is. What you don't want to do is overpay for a stock and expose yourself to long periods of poor performance. Anyway, I hope this gave you some better insights into this idea of interest rates. They can be a factor at times. I'm not denying that interest rates don't have an impact, especially on the market value. But the market value and the intrinsic value of a stock are not the same thing. Anyway, it's been Chuck Carnival saying thanks for watching. Hope you enjoyed this and learned a little bit from it. I learned my lessons over time by studying this relationship between interest rates, and that's why I formulated the opinions I have. If you like this video, give me a thumbs up, ring the bell, share it with others if you think they would benefit. I really appreciate it. Thanks for watching. Talk to you again real soon.